Two things. I noticed that premiums are not going anywhere. They're pretty much stable, at least for junk silver. I look at junk silver as opposed to any other premium because it takes away other, miscellaneous factors. So junk silver premiums are something around 6%, if I remember. Whatever number they're at, they haven't moved at all, which means that still junk silver prices are moving almost exactly with the spot price. And what that means that whatever is going on now, the stackers are not participating in it as a whole. New people are not coming into the market, and that makes sense if people's stock portfolios or Bitcoin portfolios or other derivative portfolios are doing okay and they're not panicking. So we wouldn't expect that to happen. Whereas in when similar things were happening with the gold flows, we were seeing premiums go crazy, right? Because people really were panicking. They didn't know if the world was going to end. What this has to do with the monetary sewers, I was talking about the repo rate. The repo rate is another word that I'm using for the SOFR rate, the secure overnight financing rate. Secured overnight financing means a bank needs overnight financing, a certain amount of cash to close the night, and they use treasury collateral to secure that cash. So that rate is supposed to be very, very, very stable because that's the base interest rate of all other interest rates on the planet. So if it moves 1 basis point, it's a huge deal for every other interest rate. Now that's starting to get wobbly a few basis points a day. It changes like 3, 4, 5, sometimes 10 basis points a day, which sounds like nothing, but for the base interest rate of all other interest rates, it's a humongous deal. And exactly why that's happening, I can't tell you the exact mechanics of it because this is like the biggest monetary sewer in the world, but I can track the flows and I can tell you what the volumes are. And if it's wobbly, it means that the amount of cash there is getting a little bit scarce and it's going to hit some kind of break or wall or tsunami, whatever analogy you want to use. And once that happens, they're going to have to print trillions more. And it's right ahead of us. It's straight ahead.
And I was going to say, it is really interesting to watch people participate or not participate. At Zhang Enterprises, we are experiencing people that are coming in and protecting themselves with gold. And to your point, though, with the spreads not growing wider, I think it's about keeping people calmer, because typically when prices are running, and I agree with you too, Rafi, that the spot price, the only reason why I pay attention to that is because that's what people pay attention to. But this is really just a trading market, and that's the opportunity, right? To get in before those spreads get really great, because they're going to continue to try and, I don't know, maybe control the price, that the visible price that we see on gold and silver, even with the run that we've seen. And that is mostly in gold and secondarily in silver, because silver hasn't even concluded its cup yet.
The recent behavior in the silver and gold markets, particularly in junk silver premiums, and the overnight financing rates reveals a quiet but profound shift in how investors are interpreting the health of the financial system. Junk silver premiums, often used as a bellwether for grassroots retail interest in silver, have remained remarkably stable, hovering around 6% despite the surge in spot prices. This suggests that the longtime stackers, the loyal physical silver buyers, aren't yet in panic mode. There's no rush, no frenzy, and certainly no wave of new buyers flooding the market. In other words, the silver crowd isn't reacting like they did in past crises, at least not yet. This calm stands in stark contrast to moments in the past when gold or silver premiums would spike dramatically as people scrambled to hedge against looming instability. One of the reasons for this measured calm is the performance of other asset classes. As long as stocks, Bitcoin, and derivatives are still showing decent returns, investors are more likely to sit back and watch than rush into metals. However, under the surface, another story is playing out. This one not in the physical world, but in the monetary plumbing of the financial system itself. The Secured Overnight Financing Rate, or SOFR, which replaced LIBOR as the base rate for overnight loans, has been anything but stable. It's been moving not by 1 or 2 basis points, but sometimes by 3, 5, even 10 basis points a day. For most people, that sounds like a rounding error, but in the world of sovereign debt and interest rate derivatives, it's seismic. This kind of movement in the world's benchmark rate means the deepest part of the financial system is feeling stress, and liquidity, real secure liquidity, is drying up. The repo market is the heartbeat of the banking system. When a bank needs to borrow money overnight to meet its reserve requirements, it pledges U.S. Treasuries as collateral and borrows cash. The rate at which this happens is SOFR. Because Treasuries are considered ultra-safe collateral, the rate should be almost immobile. If it's bouncing around, it means either the collateral isn't as trusted as it used to be, or the cash to lend against it is drying up. Neither is good. It's like the gears of the global monetary engine grinding with a little more friction each day. When this happens, central banks step in and print, trillions if necessary, and when they print, the purchasing power of fiat currencies drops. That's when physical gold and silver stop being luxury hedges and start becoming lifeboats. From a strategic point of view, the fact that premiums haven't spiked is actually an opportunity for calm investors. When fear really hits, premiums explode, and finding bullion becomes either difficult or expensive. Right now, with the markets relatively quiet and junk silver tracking spot almost exactly, it's the ideal moment to build or expand positions. Because the gap between physical and digital gold and silver markets is growing, and at some point they will collide. The digital prices, futures, ETFs, unallocated positions, are showing one reality, but physical metal is telling another story. The illusion is maintained only through confidence and liquidity. When liquidity breaks, the illusion breaks with it. The current calm in precious metals is not an indication of safety, but a reflection of managed perception. Authorities and institutions are focused on maintaining appearances. If they can keep people from panicking, they can buy time. But time is exactly what's running out. Since 2015, liquidity in the treasury markets, the foundational markets, has been quietly deteriorating. That trend is accelerating. We're seeing more signs of stress emerge, from the bond market volatility to the weak response of equities to economic data. Inflation is still sticky, and while it may come in slightly lower than forecast one month and higher the next, the trend is deeply embedded now due to years of monetary expansion. Gold's long march upward is not a surprise. It's been on this path since the dollar was unpegged from it in 1971, and it will continue to climb as long as fiat money is produced without limit. The danger isn't in the nominal gold price hitting an all-time high. That's a psychological milestone, sure, but not a systemic one. The real danger lies in what happens when gold begins outperforming traditional financial assets, when the ratio of gold to the S&P 500 starts climbing steadily. That's when perception begins to shift. People begin to realize that their stock portfolios, their retirement accounts, their paper assets are losing purchasing power against real money. That's when the panic begins. The shift away from stocks, bonds, and yes, even Bitcoin, for some investors, becomes a tsunami into gold. Not necessarily because they believe in gold as a philosophy, but because they see that everything else is failing in real terms. That moment doesn't require a specific catalyst. It could come on a random Tuesday. It could happen with a flash crash, a bad bond auction, a debt downgrade, or simply the accumulation of small stressors that suddenly coalesce into panic.
But I think it's really interesting that, we are seeing more of an influx of new buyers in, and we do a sound money foundational strategy, and everybody needs to have that because it's all the uncertainty that is in the markets. And also, Rafi, you brought up the liquidity that's drying up in the repo markets, which is the key market, to your point, that underlines all of the global debt and all of the global markets. And we've actually been watching a lack of liquidity in the treasury markets, the foundational markets, since 2015. And that's just getting worse and worse and worse. And that's also takes us back to the difference between the digital gold market and silver market and the physical gold and silver market. These two are colliding. I don't think they want anybody to really realize how much they are colliding. And it's really about perception management, that if they can manage how you perceive things, then they can manage how you move forward.
Yeah, that's an interesting point.
Liquidity issue getting much, much worse. It is that sticky inflation and also market uncertainty, because there is a lot of uncertainty in these markets. And hey, the inflation print came in hotter than expected today. Well, that would be for some, but I'm not surprised.
What brought us to this level? The fact that we've been increasing the supply of dollars since 1971 and before. So the same forces that have been bringing gold higher since 1933 are still bringing it higher today, and it'll keep doing that. I don't think the all-time high in nominal terms, or at least in dollar terms, is really that significant. It's psychologically significant. People are going to be talking about it. We'll be talking about it. It's psychologically significant even to us. But in terms of the danger of the number, I think that it's really going to become a dangerous game when the gold to S&P 500 ratio, not specifically the gold to S&P 500 ratio, but just use that as a proxy of gold to stocks, when that really starts to rise, and people's dollar amounts, and they imagine a certain amount of purchasing power in their portfolios, when that really starts to fall versus gold, people are going to panic and get out of all their derivatives, including stocks and bonds, and in my opinion, Bitcoin. But I'm not sure if we agree on that, but if we don't, that's fine. And really pile into gold. And in terms of a catalyst that could bring us to 3,000, I don't think we even need one. It could just randomly go there. Like today.
What makes this period in financial history so unique isn't just the technical signs of stress. It's the deafening silence from the broader public. In part one, we saw how junk silver premiums haven't budged, even as gold has taken off. That's not because nothing's happening. It's because we're standing in the eye of the storm, where everything looks deceptively calm. The bond market is cracking, liquidity is drying up, the global monetary plumbing is making strange noises. But the public, for the most part, is unaware. They're checking stock tickers and crypto wallets, not repo market spreads or SOFR volatility. That's what makes the next phase potentially explosive. Because this isn't just a financial shift, it's a psychological reckoning. Every fiat currency collapse in history has followed a predictable path. First comes denial, then resistance, then panic. What's holding the current system together isn't real solvency, it's belief. And that belief is a fragile thing. It's propped up by stock market optimism, media narratives, and the day-to-day inertia of a public that doesn't have time to study Austrian economics or monetary history. But once people begin to see the cracks in real time, when they go to buy physical silver and are told it's back-ordered indefinitely, or when they try to withdraw a large sum from the bank and are met with questions and delays, then the panic switch flips. Confidence once lost is nearly impossible to restore. We already saw hints of this during the 2008 crisis. Back then, it was subprime mortgages and Wall Street greed that woke people up. But central banks papered over the collapse by printing trillions and slashing interest rates to zero. That worked for a while. What they didn't do was fix the underlying problem. They just made it bigger. They replaced a housing bubble with a sovereign debt bubble. They turned the monetary base into an exponential curve, and now they're cornered. They can't raise rates without breaking the system, but they can't keep printing without destroying the currency. That's not a dilemma, that's a death spiral. Meanwhile, the divergence between the digital and physical markets for gold and silver has become undeniable. COMEX contracts, ETFs, and unallocated accounts offer the illusion of metal ownership without actually delivering the goods. It's fractional reserve banking, but for bullion. And when demand for physical spikes, as it inevitably will, those promises will be exposed as worthless. The reality is this: there simply isn't enough deliverable gold and silver in the system to satisfy even a fraction of the paper claims. That's not speculation, it's math. Imagine a scenario where institutional players, hedge funds, sovereign wealth funds, or even central banks decide to take physical delivery of their metal en masse. They might do this quietly at first, converting ETF shares into actual bullion or redeeming COMEX contracts for warehouse receipts. But once the vaults begin to empty, the entire paper market will come under scrutiny. Prices on screen will become irrelevant because there will be no metal to buy. Dealers will simply say, "out of stock," or call for pricing. That's when the masses will realize the truth. If you don't hold it, you don't own it. This scenario isn't fantasy. It's happened before. During the COVID crash in March 2020, premiums on silver eagles soared over 100% above spot. Physical gold was nearly impossible to find, and that was a short-term panic. What happens when the panic is structural? What happens when the supply crunch isn't due to temporary logistics, but to a permanent breakdown in the confidence that underpins the financial system? That's the question nobody in the mainstream financial media wants to ask. But gold and silver buyers are already answering it with their wallets. Take the central banks, for instance. They're not buying COMEX contracts. They're buying bars. Physical, audited, serial-numbered gold, shipped home and locked in vaults. Why? Because they know what's coming. They know that fiat currency systems don't collapse with warning bells and press conferences. They collapse gradually, then all at once. And when that moment comes, the nations holding the most gold will have the most leverage in rebuilding the monetary architecture. This isn't about nostalgia for a gold standard. It's about cold geopolitical calculus. As the dollar weakens and the US loses its grip on reserve currency status, new systems will emerge. China, Russia, and the BRICS nations are already preparing their own settlement networks, possibly backed by gold. The IMF is openly discussing digital SDRs. Even the BIS has reclassified gold as a Tier 1 reserve asset, putting it on par with cash and treasuries. These are not the moves of institutions that believe the current system is sustainable. These are exit strategies. And yet most investors remain oblivious. They see gold at $2,500 or even $3,000 and think it's too late to buy. But they're missing the point. Gold is not an investment, it's an insurance policy. You don't buy it to make money. You buy it to avoid losing everything when the system resets. And in that context, $3,000 gold isn't expensive. It's cheap. Especially when you consider that the purchasing power of fiat currencies is eroding by the day. Eggs, housing, healthcare, education, everything costs more. And yet the government insists inflation is under control. It's not. The numbers are cooked and the markets are manipulated. But reality has a way of asserting itself. And when it does, gold and silver won't just go up, they'll explode. There's also a growing risk of capital controls. As governments struggle to maintain control over capital flows, they may introduce taxes on gold transactions, limits on withdrawals, or even bans on private ownership. This has happened before, in the United States in 1933, in India in the 1960s, and in countless other nations throughout history. When the debt gets unpayable, governments always look for assets to confiscate. That's why physical possession matters. It's also why decentralized ownership, private vaulting, and cross-border planning are becoming more relevant by the day. We're now in a race between awakening and collapse. Every day that goes by, more people realize what's happening, but it's still a tiny minority. The majority are asleep, lulled by financial media and monthly account statements. But those numbers on a screen don't mean anything if the currency behind them dies. If your IRA is worth $1 million, but a loaf of bread costs $500, are you really rich? Number. That's the illusion of wealth, one that vanishes the moment confidence breaks. And confidence is already cracking. The Federal Reserve may talk tough about controlling inflation, but their balance sheet says otherwise. Every time the system wobbles, they print. And every time they print, they destroy the value of the dollar. That's not speculation, it's history. Since 1913, the dollar has lost over 98% of its purchasing power. Since 1971, when Nixon closed the gold window, gold has gone from $35 an ounce to over $2,000. That's not gold getting more valuable. That's the dollar dying slowly. The final phase will be marked by a shift in sentiment, a moment when the public finally realizes that fiat money is a rigged game and that only real assets matter. At that point, the rush into gold and silver will be unstoppable. Premiums will skyrocket, inventories will vanish, and those who waited will be left with regrets instead of ounces. In summary, the second part of this story is not about what's already happened, it's about what's coming. The illusion is still intact, but just barely. The plumbing of the financial system is leaking, the foundation is cracking, and the walls are starting to shake. The time to prepare is not after the crash, it's before. Because once the panic begins, the doors will close. You won't be able to buy metal. You won't be able to move money. You won't be able to exit the system. That's why those who understand are acting now, quietly, steadily, and with purpose. They're buying real money, not because they're doomsayers, but because they understand the math, the history, and the pattern. Fiat currencies die, debt bubbles burst, and when they do, gold and silver aren't optional, they're essential. The world is changing fast. The endgame is approaching, and when it arrives, the question will be simple. Did you prepare in time? Or are you still holding paper, praying for one more rally?
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.